Now, you know that I love income, and one of the best vehicles for income is almost undoubtedly business development companies, or BDCs. Well, if that's the case, then a very obvious question is, why am I not all in to BDCs? Why am I not almost exclusively investing in BDCs? I know them well, I know what to look for, I know what to be careful about. So why not just invest in BDCs? And the answer is very simple. I do enjoy some market-like returns. One of the big challenges is if you invest only in BDCs, you will lack diversification. Now, all of the BDCs, they are very different. They all invest in different areas and companies of different sizes. Some take equity stakes, some take credit stakes, some have a first lien loans, and others have less secure loans. Some invest in different geographic areas, others invest all over the place, some invest in specific sectors, some have more concentrated sector exposure. And so, even within BDCs, yes, there is diversification, but there's not then diversification in my portfolio if I had a portfolio consisting entirely of BDCs. Now, this is important because, like anything, other external situations can cause a shock or a change in the system. Now, BDCs are regulated. This also means, because of the way they're set up, because of the regulations, a simple change to those regulations could upend or have very, very severe consequences for BDCs in general. Now, if that happens and my investments are solely in BDCs, then I'm in trouble. And this is simply why diversification is always important. Whether or not you love a particular type of company or a particular sector, having diversification is key. Now, in the case of BDCs, there's a lot of very, very severe economic challenges because they lend money to companies. If the wider macroeconomic environment is not doing well, then those BDCs are not going to do well either. Now, this is obvious when you think about it. But the challenge is that if I was only invested in BDCs, that economic situation could affect my entire portfolio. Now, as we will soon see, if we look at BDCs, they will move in a quite extreme manner. Now, part of the reason is they can trade at a premium or a discount to the net asset value of their holdings, which is helpful and useful in some circumstances, but it also means that if there's a shock, the prices can overreact and move far too fast, far too quickly. Now, if all I was holding was BDCs, and they tend to be correlated with each other, then it could result in my portfolio suffering a fairly large loss fairly quickly, and that can be very hard emotionally to deal with and to manage, even when there is good income coming in. Now, the other important thing with BDCs that it's useful to think about is total return. A BDC is not a price-oriented investment vehicle. I'm not looking for a price gain. And yes, there are examples like Main Street Capital where the prices do go up with time, but much of the time the prices trade sideways, with some fluctuations up and down, of course. But most of the time the prices trade sideways and there's not a lot of price gain. Much of the return from a BDC is going to come from the dividends. Now, if you flip that around, I want to see those net asset values increasing. The value of the investments and the assets that the BDC controls, I want to see that increase with time. And on top of that increasing, I want to see that BDC paying me money, dividends, income to me. So that gives me two forms of return. Number one is the dividend that I receive, and then number two, if the net asset value increases with time, prices tend to follow the net asset value. Look for the total return. Look for growing net asset values, and look for then the dividends on top of the growing net asset value. Yes, I do love Main Street Capital. It is a fabulous BDC. It is very well managed and it pays a consistent growing dividend. It pays on a very, very regular monthly basis. So why then did I recently exit my position in Main Street Capital? Now, one of the key reasons is looking at the wider portfolio, looking at most of the BDCs, Main Street Capital is a little bit of an outlier because even though it has a particular net asset value, the value of the company is substantially higher. Now, what this means is that the company is trading at a premium to the net asset value, the underlying value of the holdings that they have. This has several consequences. Number one, if something was to go wrong, if investors were to lose their confidence, that price could drop down to that net asset value, and that would represent a very substantial capital loss, one that I don't want to be exposed to. Would that happen? I don't know. But I do know that in times of uncertainty and in times of risk, many investors do get spooked. And as a consequence, they do tend to move those prices. And the prices can be incredibly volatile with a BDC. And so that premium can very rapidly potentially disappear. Now, the other challenge there is I'm most interested in a BDC that grows its net asset value. Now, even if Main Street Capital continues to grow that net asset value with time, which I'm sure they will do, it still leaves open the very challenging situation of prices could go sideways. So even if the company is growing, the underlying actual company, their business, the assets that they have, even if that is growing, if the prices are going sideways, in other words, a slow compression of that premium, that's not a situation that I want to be in. Yes, I will be getting those dividends, but I also would like to see the prices increase in line with the net asset value. So when you're thinking about this, it would suggest that a BDC that's perhaps trading in a roughly 1-for-1 ratio of price to net asset value, as the net asset value grows with that BDC, the prices are more likely to follow it upwards. And so I'm going to get the dividend as well as that price increase. And it's probably going to be more of a sure thing. Now, this begs the question, of course, why does a company like Main Street Capital have a strong premium associated with it? Why are investors prepared to pay more than 50% of the value of the net asset value to have those shares in a company, in a BDC that's got that strong reputation? What's going on there? Well, in a very simple sense, Main Street Capital has demonstrated incredible capability in terms of their management of those assets. A newer BDC doesn't necessarily have the same track record, it hasn't been through those tough times, hasn't had a management team that's made the tough decisions, the tough calls, and got through some sticky situations. A new BDC, it doesn't have that track record. And so the new BDC is more likely to trade at a 1-to-1 ratio of price to net asset value. Over time, however, that BDC does grow the net asset value and it grows at a slow and steady rate, then we're more likely to see people and investors and other investment companies take notice of the steady and strong performance and then add to the value, taking that price to net asset value ratio up above 1 to 1.1 to 1.2 or even higher. So that would suggest that the trick is to identify a company that is doing well, a BDC that is doing well, that can be successful, and buy them as they're trading at that 1-to-1 ratio and hold it for a long period of time. And that can be a very powerful way of trading into the BDCs. Now, business development companies, yes, I do love the common stock. Yes, I love having that ownership stake in the company. And I love the juicy fat dividends of often 8 to 12% that these companies will pay me. Now, many of these companies will pay a standard level of dividends that they will hold steady or increase very slowly over time. And on top of that, they'll often add frequent, regular special distributions of, for example, some capital gains or of their fluctuating income, where they use a special dividends to enable them to add to the dividend income of the investors without putting themselves at the long-term risk of increasing a dividend and then having to drop the dividend if they hit on difficult times.